Good evening, everyone. This is Dana from NexGen. I hope you're enjoying the Me Inc. weekly series. If this is your first time here, welcome. In this live, we are discussing interest, specifically compound interest. In week 2, we did Angela's 2022 budget. She paid off her credit card debt. Now she wants to pay off her mortgage, car, and student loans within 5 to 7 years. At the same time, she wants to build her savings, which is 1 year of expenses. This can be done. To do so, we need to understand how interest works. Normally, when we buy goods and services, we have the money to pay for them. We exchange our current funds for the purchase. For example, if I wanted to buy a blouse from the store, I would either pay cash or write a check for the purchase. Because the merchant is confident that I have the funds to write the check, they allow me to leave the store with the blouse I purchased, on sale of course. Now we can exchange future funds for the goods and services we want now. That same blouse on sale can be purchased with either that store card or a credit card. Using these cards allows me the option of not having the funds currently, but that I would pay it in the near future. In exchange for borrowing the funds, because that's what I would be doing, from the store and or lending institution, I pay interest. Just like the lending institution, we can receive interest as well. It's called interest income. Let's look at what interest we normally pay and receive. Now, the interest we pay on the left-hand side, whether it be a mortgage, automobile, personal loans, credit cards, or student loans, people are familiar with these types of interest that we pay, and it's for things that we don't pay outright. So if you look on the right-hand side, we have interest that we can receive. So if you put money in the bank or the credit union, you can put money in the checking account, you can put it in your savings, money market, or certificate of deposit. So checking, Angela is using her checking so that she can pay her bills. The money would then, any other money would go into her savings account. The savings account, now the checking does pay some interest. The savings pays a little bit more interest. The difference between the checking and the savings is at one time, the savings was restricted as to how many transactions you could do. In checking, you could probably do as many as you would like. In the credit union, the banks may be different. So in savings, usually when you're opening an account in a credit union, you have to put some money in what they call a share account or savings, and it's usually $5. Money market, the money market that she uses, it gives a little higher interest income than the checking and the savings. The difference with the money market is that you may have a higher minimum that you need to retain. Some require you to have at least $1,000. Some require you to have $2,500 to receive the higher interest rate than in savings and checking. Now, so the certificate of deposit is different from the money market because the interest rate is fixed for a period of time, whereas it may fluctuate in the checking, savings, or money market. In the certificate of deposit, you would set aside a certain amount of money for a certain period of time to receive a higher interest rate. And usually they don't have a lot of transactions going in and out. However, on a certificate of deposit, you can roll the interest back into the CD. And that will help you with the compound. And we'll talk about that in a minute. So what is the difference between the interest that we pay and the interest that we receive? Okay, so in the interest that we pay, it's usually higher than the interest income. For example, thus far, the highest that I've seen on a certificate of deposit or checking, or actually certificate of deposit, is 3%. I usually see a higher interest rate, or what they call an annual percentage rate, on everything else, as high as 25%. So when the lending institutions lend money, they're lending it to receive a higher amount of interest. The initial rate can fluctuate, and it depends on your credit. Whereas when you receive interest, it's pretty much the same for everyone. However, when you're borrowing money, the rate can be different per borrower. And depending on your credit, that can also dictate what interest rate they will offer you. The rates can change during the borrowing period. And unfortunately, in most cases, you're paying interest on a depreciating asset. So let's talk about that. Okay, let's take a look at one that people are most familiar with, and that's the credit card. So I've given you a sample of a credit card statement, and there's some important things that I'd like you to take a look at. Normally, when you have a credit card balance, it's in your best interest to pay it off in full before the due date. And the reason why that's to your advantage is if you purchase something and you paid it off before the due date, it is the same as though you paid cash for the purchase. However, if that balance is carried over to the next billing period, then you may be paying interest. So, this is not, I'm not talking about promotion terms where it's 1 point something percent or 0%. I'm not talking about that. Now, when you have a promotion, especially if it's at 0%, you want to make sure that you adhere to the terms of that agreement, because it's not going to do you any good if you make a late payment or you don't pay the required minimum payment. Now, on the credit card, they are reporting your payments to the credit bureaus. If you don't pay when you're supposed to, you can be charged a late fee, and that could subsequently change your interest rate. But of course, the credit card companies can change the interest rate at any time. Now, so let's take a look at this statement. Okay, so we have the new balance at $8,800, a little over $8,800, the minimum payment that is due on the 22nd of December. So if you look further down in the shaded box, something that's very important that I'd like you to pay attention to. What they're saying and what these boxes represent is if you don't make any other purchases. If you make additional purchases, then these numbers are not going to make any sense. They're not going to be correct. So with this new balance, if I only make the minimum payment, I will have this balance paid off in 18 years. Again, this is if I don't make any additional payments. So for a $8,800 balance, I could invariably pay just over $14,000. That's the power of compound interest. Of course, it's not in our favor. So let's say I pay more than the minimum payment. Again, I'm not making any other purchases. I will actually have it paid off in 3 years. And of course, they have this that I'm saving $4,200. Actually, I'm not saving anything. I am spending more than I purchased. So that's something that you want to pay attention to with the credit card. Now, remember I was talking about a depreciating asset? The depreciating asset is probably the things that I'm purchasing on my personal credit card. So this is usually for unsecured purchases. Let's shift over into secured purposes. Secured purchases. In this example, we have a automobile loan or car loan. It is pretty much the same as the credit card, except the auto loan is probably not revolving. And what I mean by that is that just like the credit card, your payments are reported to the credit bureau. You have to be approved to get the automobile loan from the lending institution, and usually it takes minutes and it's a fixed amount, which is unlike the credit card where the rates can change. The security is the vehicle. If you don't make the payment, they take the vehicle. Now, just like Angela, you can take that car and refinance it for a lower rate. And of course, there are late fees if you don't make the payment when you agree to. And as I said before, they have the right to repossess the vehicle, which is what you don't want to do, or you don't want to have done. So we took a look at the credit card, which is usually for depreciating assets. We can pay upwards of 30+% interest to the lending institution. The automobile loans, it can range from 0 to 8 to 24. So I've seen some as high as 25%, but it's for a fixed period of time. So there's another secured purchase that we can make, and that is the mortgage or the home loan. Okay, so for the mortgage, it is secured by the home. So unlike the automobile loan, it's going to take longer for the process. The process is longer than an automobile loan or even a credit card loan. It's for usually a 15-year or 30-year term. And if you get a fixed rate, then it's fixed for the life of the loan. I don't want to get into anything too much about the other stuff because there are different types of loans. I'm just going to study and fix on the fixed rate for now. Okay. Now, before, if you were paying interest, you can write it off, whether it be credit card, personal loans, or even car loans. And right now, I think the only interest you can write off on your taxes is your mortgage in most cases. They report your payments again to the credit bureaus. And again, just like the automobile, you can refinance at a lower rate. There are late payment penalties if you don't pay on time. And just like the automobile, if you don't make the payments, they can take the home away from you. So these are examples of interest that you pay. So what I'd like to do is do a comparison for the interest that you pay and the interest that you receive to show you the difference and how it actually works in your benefit, to your benefit, all things being equal, to receive interest as opposed to paying interest. As I said before, most of our purchases are for depreciating assets. In other words, the value of the things we purchase is reduced due to usage, passage of time, wear and tear, depletion, or other factors. Sometimes we don't even use the things we purchase. I would like to do a side-by-side comparison on an asset that usually does not depreciate. I'm going to do a 30-year comparison on a mortgage that's principal and interest only, and using that same amount of money to put aside in savings. If I took out a $250,000 mortgage for 30 years at 3% interest, The total payment would be $1,054.01. That's how much I would be paying in principal and interest. Let's take that same amount, or let's take a penny off, and put aside and save $1,054 for 30 years. Both payments are going to be the same, with the exception, I think with the payment, when I took off a penny, it'll be $379,440. That's for the people that are paying attention. So they're going to be approximately the same number or same amount in payments. But there is a difference between the interest that I pay and the interest that I receive in interest income for the savings. Now keep in mind, as I've said before in previous videos, when you purchase a home, even though you may take out a 30-year mortgage, you can pay it off in less time. And remember, Angela's goal was to pay it off in 5 to 7 years. So the interest I'm getting ready to show you is if there was no additional refinancing and she paid out the payment amount for the entire 360 months. Now, we're going to see why receiving interest is better than paying it. All things being equal, after 30 years, you will have paid $129,443.63 in interest for the home, in addition to the home, of course. In contrast, if you saved that same amount, or a penny less for those paying attention, you will have received $232,027.88 in interest income. After 30 years, you will have $612,521.88. When you pay interest, it's on the decreasing balance. When you receive interest income, it is on the increasing balance. If you didn't know, now you know. You can see why Angela wants to stop paying interest on her car, mortgage, and student loans as soon as possible. You'll also see why she can grow her savings to reach her goals quickly. Thank you for spending this time with me. Please make sure to see the additional information in the description below. From our family to yours, be safe and happy holidays, and I will see you next week. Don't forget to like, comment, share, and subscribe.